Welcome to the first video series where we will talk about some important concepts about banking and the current state of economy. We are in that part of economic cycle which no one likes to be in. That is the rate hike season. No doubt rising rates are bad for the economy. However, rate hikes bring challenges and opportunities for banks as it increases their NII, that is the net interest income, which is generally the difference in interest earned from its asset and the interest paid on its liabilities. But before we deep dive in the subject, let's see how we reached here. It all started in 2019 when COVID was introduced to the world. Now, whether it was created in a lab or it spread through some bat, no one knows about it. However, soon it was declared as a pandemic by the World Health Organization, and the world came to a standstill. Apart from some essential services, almost everything was shut. As a result, there were massive layoffs and financial markets collapsed and people lost their loved ones. In 2021, the economy started picking up as the restrictions and lockdowns were lifted. But there came another surprise, that is the war between Russia and Ukraine, that acted like cherry on the cake and worsened the situation as it took commodity prices to a new high, as Russia and Ukraine account for a large share of commodities like oil, natural gas, sunflower oil, wheat, etc. Then the government and central banks around the world started taking action with lowering rates near to zero, quantitative easing, printing money, and giving stimulus packages to their citizens. Now we have Economics 101. As a result, due to demand and supply gap, since people had enough money at their disposal, but the supply of goods was less due to supply chain disruptions, inflation started picking up. And since people had discretionary spending power, the money flew into risky assets like stocks, crypto, NFTs, etc. Now, to control this inflation, Fed and central banks have to raise their rates and do quantitative tightening to bring inflation under control. Now, coming back to our topic, what does it mean for the banks? Banks' balance sheet consists of assets and liabilities. On the asset side, we have loans, mortgages, credit cards, investments, and on the liability side, we have demand and time deposits, CDs, etc. Bank take deposits at a certain rate and lend them at a higher rate to earn income, which is called NII. If the short-term asset is funded by a long-term liability or a long-term asset is funded by a short-term liability, this kind of situation can put bank into a repricing or refinancing risk. Banks use two models to safeguard itself from such scenarios. One is called the repricing risk model and the duration gap model. We will look at the repricing risk model in this video series and the duration gap in another. Now, the repricing risk model, it arises due to mismatch of maturities on the asset and the liabilities and give rise to refinancing or repricing risk. Let's say bank has funded a 10-year fixed rate loan at 10% by a 2-year term deposit at 9%. Ideally, 10-year loan should be funded by a 10-year deposit. However, in this case, it has been funded by a two-year deposit, which will be rolled over, but the rate may not be the same. So if the rate of the deposit increases by 12%, then the bank will have an impact in its NII. So that is what it is about, and I will attach this Excel in the video. Thanks for watching. Thanks for your time, and please subscribe, like, share, and subscribe. Thank you.